Silver just smashed through $117 per ounce, an all-time high. Gold breached $5,500, entering completely uncharted territory. Yet Bitcoin, the asset we were told was digital gold, the hardest money ever discovered, is struggling to hold $90,000. In fact, it's down over 30% from its October peak. While the shiny rocks our ancestors used as money are skyrocketing, the future of finance is bleeding out. Why is the hardest asset on Earth losing to physical metal? Is the digital gold narrative dead? Or are we witnessing one of the greatest bear traps in financial history? My name is Alex and you're watching Web3 Verse. I'm not a financial advisor and nothing here is financial advice. This is educational content to help you understand macro forces shaping your portfolio in 2026. That sounds good, smash that like button. The divergence we're seeing right now is mind-boggling. Let's examine the numbers. Silver didn't just have a good year in 2025, it skyrocketed 150%. Year to date in 2026, it's already up another 55%. Gold, the boomer rock that crypto social media loves to mock, surged 65% in 2025 and has continued its relentless march upward, currently trading above $5,000. Meanwhile, Bitcoin crashed from an all-time high of roughly $126,000 in October 2025 to around $88,000 by late January. That's a brutal 30% collapse during the exact same period precious metals were hitting all-time highs. If Bitcoin is supposed to be a safe haven, why is it trading like a tech stock in the middle of a recession? To put things in perspective, we need to discuss the safe haven narrative because right now that narrative is being tested like never before. When geopolitical tensions flare, whether the dispute over Greenland, escalating tariff wars, or fears of US government shutdown, capital has a choice. It can flee to assets with 5,000 years of history, or it can flee to an asset with 15 years of history. In late 2025 and early 2026, fear chose 5,000 years. The Greenland crisis specifically rattled markets more than most realize. When major geopolitical powers posture over territory and resources in the Arctic, uncertainty drives institutional money into the deepest and most liquid defensive assets available. Right now that's gold. During peak crisis panic in late 2025 and early January, we saw days where nearly $500 million exited Bitcoin ETFs in a single session. In total, Bitcoin ETFs hemorrhaged roughly $6 billion from late 2025 through early January 2026. But here's where things get interesting. That money didn't disappear, it rotated. While Bitcoin ETFs were bleeding, gold ETFs globally attracted a staggering $89 billion in inflows throughout 2025. Capital isn't leaving markets, it's rotating from digital to physical. Institutions faced with regulatory uncertainty from the stalled Clarity Act and looming tax loss harvesting deadlines decided to park their wealth in the asset class that has survived every empire in history. Is Bitcoin actually a safe haven, or is it still just a risk asset? The uncomfortable truth is Wall Street still treats Bitcoin like a high-growth tech stock. Bitcoin's correlation with the S&P 500 remains stubbornly high, sitting around 50 to 80% depending on time frame. Meanwhile, its correlation with gold is at multi-year lows, hovering near zero. When the Nasdaq bleeds, Bitcoin bleeds. Until institutions formally reclassify Bitcoin as pristine collateral, something beginning to happen with CFTC's pilot programs but isn't fully operational, Bitcoin remains trapped in what we call risk asset purgatory. But there's another factor at play here, specifically regarding silver. Industrial demand. Silver's rally is structural, not just speculative. Industrial demand for silver hit a record 680 million ounces in 2024. That's nearly 60% of total global demand. Wow. The green energy transition and AI boom are both built on silver. Each solar panel contains approximately 20 grams of silver. Battery electric vehicles can consume up to 50 grams of silver each, twice as much as traditional combustion engines. But the real kicker is the AI data center boom. We often hear about energy needs of AI, but rarely about physical infrastructure. To power these massive hyperscale data centers, companies are building massive solar panel arrays. A single 500 megawatt solar array, the kind needed to power one of these AI behemoths, requires somewhere between 5 and 12.5 metric tons of silver. Silver backs the AI boom. Silver backs the energy transition. Silver backs electrification. Bitcoin backs a monetary network. Don't get me wrong, that monetary network is valuable. But when fear dominates and industrial engines are revving up for a wartime protectionist economy, physical utility matters. This is compounded by the fact we're in the 5th consecutive year of a structural supply deficit in silver. We've burned through over 800 million ounces of cumulative deficit since 2021. The vaults are draining, and that's why silver is smashing all-time highs. Does this mean you should sell Bitcoin and buy silver? Before you do anything rash, you need to understand the rotation theory, because if history is any guide, the metals rally might actually be the best leading indicator for Bitcoin we have. History shows a distinct pattern in liquidity cycles. Metals pump first and then Bitcoin pumps. Analysts have observed that gold typically leads Bitcoin by roughly 3 to 7 months. Think back to 2020. Gold hit an all-time high in August 2020. Bitcoin didn't start its parabolic run until late Q4 that year. The lag is real. If this cycle holds, Bitcoin's current stagnation isn't a sign of death. It's simply a timing mismatch. The massive rally in gold and silver that began in late 2025 could be setting the stage for a violent Bitcoin breakout in Q2 this year. Why Q2? That's when the macro environment is expected to shift. Right now, the market is pricing in the Federal Reserve resuming rate cuts around June 2026. When rates come down, liquidity expands, and when liquidity expands, capital rotates out of defensive havens like gold into faster horses like Bitcoin. The current divergence is frustrating, but it's mathematically consistent with previous cycles. Here's the news flash bears are ignoring. While retail investors panic sell because Bitcoin dropped 30%, larger investors have been buying the dip. One example is Strategy. During the so-called weakness of Q4 2025, Strategy didn't sell. They accumulated a staggering $20.5 billion worth of Bitcoin. They didn't stop there. In a single week in early January 2026, while ETFs were bleeding, Strategy scooped up another $1.25 billion. They aren't the only ones. On-chain data shows the average cost basis for Bitcoin ETF investors sits right around $84,099. This is a critical level. It represents a historical support zone where institutional money has drawn a line in the sand. We've seen Bitcoin bounce from this region multiple times because the institutions that allocated billions at this price point are not day traders. They are allocators. They're defending their entry. What closes the gap between gold and Bitcoin? Comes down to two things: the Fed and the Clarity Act. The Fed is expected to cut in Q2, but the regulatory piece is just as important. The Clarity Act, stalled in legislative purgatory, is causing massive uncertainty. Institutions hate uncertainty and love gold because gold's rules don't change. But if we get clarity, if stalled legislation finally moves forward potentially later this spring, that regulatory risk premium evaporates. When it does, Bitcoin's risk-on properties combined with its hard money properties create a perfect storm for upside. Is the digital gold narrative broken? No, it's just paused. Remember, gold has a 5,000-year head start. Bitcoin has been around for 15 years. Still a teenager. It behaves like a teenager, volatile, moody, and occasionally brilliant. But if liquidity expands and currency debasement accelerates in 2026, which seems inevitable given debt levels, Bitcoin's fixed supply becomes the ultimate asymmetric bet. The lag we're seeing is frustrating. Watching Silver Moon while your Bitcoin portfolio bleeds is painful, but marathons aren't won in the first mile. The metals are sprinting ahead because the gun just went off for the hard asset cycle. Bitcoin is still lacing up its shoes. The opportunity isn't to chase the asset that's already pumped 150%. The opportunity is to look at the asset most likely to catch up. Bitcoin plays the long game. Patience will be rewarded. Are you rotating into metals or using this dip to stack more sats? Let us know in the comments. Thank you for watching Web3 Verse, and I'll see you in the next one.